right now. You hear some people saying one thing, other people saying other things. So let's take a look at what the Fed is saying, and let's take a look at what narrative is currently prevailing in the market. Let's compare and contrast, and let's see what's ultimately more likely and how we should position. So what is the Fed saying? The Fed is saying very, very hawkish things. And today we heard from Mary Daly, San Francisco Fed governor. San Francisco, very liberal area over very liberal areas of the market. We know the liberals are the doves in this situation, at least the ones that haven't become full-on hawk, because they want to provide the government with the spending that the government wants to do. We know that they're trying to spend in deficit right now, and we expect that to continue. So, San Francisco, I've heard Loretta Mester, a more hawkish member, typically follow up Mary Daly. And Mary Daly, as far as I'm concerned, is quite hot, expecting rates to get to at least 5%. There's a whole contingent in the market that is now trying to price in less than 5%. The Fed funds market is pricing in less than 5%. But despite the CPI data, it appears the Fed has made absolutely no change to their final rate outlook. Additionally, a lot of people are saying, oh, we'll get one more hike, 50, one more 25. This is the prevailing market narrative, it seems to be. And then the Fed is going to pause. Mary Daly said just today, this is all today so far, that they're not even thinking about pausing. It's not even a topic of discussion. So if it's not a topic of discussion for the Fed, it shouldn't be a topic of discussion for you, because the Fed would be signaling that. And they are not signaling that. As a matter of fact, they are continuously, across the board, trying to walk back the hype around the CPI report. That's just the way it is. Then you get Waller. Waller's on the more hawkish end. He's saying several rate hikes into 2023, that there's more room to go into 2023. You get the point here? The Fed is trying to be hawkish. The market is trying to price in maximum dovishness. They can't say that rates are going lower than they are right now, because we know the rates are high, but they are trying to get away with the market, and the bulls are trying to get away with the maximum possible dovish move. And it seems to me that every member of the Fed is hawkish. Even the dovish members of the Fed are hawkish. Kashkari, basically indiscernible between Waller or Bullard. There used to be a big gap there. Now there's not. Now it's like there's everybody all together, super hawk, except Brainerd, Biden appointee, kind of trying to flirt with dovishness without explicitly ignoring the hawkish take and realities that are the case. So, hawkish Fed, not good for markets, causes interest rates to go up, and if we believe what they're saying, and there's every reason to do that because they've only gotten more and more hawkish and acted as such. I remember we thought a 75 was not going to happen, and here we are, 4 75s in a row, consecutive. So Fed hawkish, rates high for a year. What does next year look like compared to this year? Well, we're starting to see some signs of inflation rolling over. We're starting to see or hear from companies saying things like Walmart, for example, higher income consumers coming to Walmart for grocery. Chipotle, lower income consumers finally tapping out. Target, last month, September, October, big pain in the consumer. Well, we've had a year where rates have gone from very, very low, historical low, to, we call it, 4-5% federal funds. 10-year currently below 4%, 3.8. I mean 3.7 today. We almost broke 3.7. My opinion, that's very low. Regardless, even if they're pulling back now, even if that's only a temporary move, rates are higher now than they have been all year. And we're starting to see some effects of that. Next year, we're going to have rates at this level and held there the whole way. And Mary Daly, who we were talking about earlier in this video, brought up something rather crucial. And that's the notion that, yes, inflation might pull back, but as inflation pulls back, real rates go up. Important to note that real rates are going up. This is not something I've discussed on this channel. This is something that I knew was true. It's not new information to me, but it's not something I was actively thinking about, and I don't think many of us were actively thinking about the fact that when inflation comes down, the Fed continues to hike and is going to hold rates up for a long time, okay? They're not going to drop them back. A lot of people thought they were going to drop them back. It's not going to be the case. They're going to hold them. If inflation comes down, which is objectively a good thing, real rates go up, which is objectively not a good thing. So the point here is no need to get over exuberant chasing a rally. I think there's going to be a little bit more correction to come. And when that correction comes, we want to buy into the weakness, not into the strength. That's when we've done our best buying over here on this channel. When stuff is down, we buy, not typically when stuff is up. So that's today's video. Don't lose sight of the Fed. Let's keep our eyes on the Fed. Don't fight the Fed. Again, that's today's video. And until next time, peace out. Have a good one.